If your credit card statement shows a minimum payment you can afford, but the balance barely moves, you are not bad at money. The payment system can keep you paying interest over time. In this video, I will give you a practical 5-step credit card debt reset for life in the United States. Stop the leak, map the debt, choose a payoff order, protect your cash flow, and build a buffer so the card does not become your emergency fund. This is general education, not personalized financial advice. Your rates, terms, and situation may be different, so check your actual card agreement. Step 1. Stop adding new debt while you are trying to remove old debt. That does not mean you need to cut every enjoyable thing from your life. It means you need a clear rule for the cards you are paying down. For example, you might remove a stored card from shopping apps, pause new purchases on the payoff card, and use a debit card or cash for planned spending. Keep the account information somewhere safe. Do not close an account automatically just because you want the balance gone. Closing a card can affect your available credit and may have other consequences. Understand the terms first. The goal is simple. If you send extra money to a balance this month, new spending should not quietly rebuild it next month. Step 2. Make a one-page debt map. For every card, write down the current balance, annual percentage rate, minimum payment, due date, and whether any promotional rate has an expiration date. Do not rely on memory. Use your latest statement or account portal. Then add the minimum payments together. That is the amount your monthly budget must protect before you make extra payments. Your statement may also show how long repayment could take if you make no new purchases and pay only the minimum. That disclosure is useful because it turns a vague balance into a timeline. Paying more each month generally reduces the interest you pay and the time it takes, but the exact result depends on your rate, balance, fees, and new charges. This step is not about shame. It is about replacing a foggy problem with a number you can manage. Step 3. Choose a payoff order and stick with it. The avalanche method sends extra money to the card with the highest interest rate, while you pay the minimum on the others. This can reduce interest cost, but the first target may take longer to disappear. The snowball method sends extra money to the smallest balance first. It can create a quick win and make the plan easier to follow, even if the highest rate balance is not first. Neither method is magic. The best method is the one you can follow consistently without adding new debt. Here's a fictional example. Alex has 3 cards, a large balance at a high rate, a medium balance at a lower rate, and a small balance with the lowest rate. Alex can put $450 a month toward debt, including minimums. With Avalanche, the extra payment attacks the highest rate card. With Snowball, it clears the smallest balance first. The important part is not the label. The important part is that the payment amount is fixed, the target is clear, and every paid-off balance gets rolled into the next target. Step 4. Create a payday order. On every payday, cover essential bills first. Then, make at least the required minimum payment on every card. Automate minimums if your cash flow allows it, and schedule the extra payment for your target card soon after payday. Do not wait to see what is left at the end of the month. That money usually disappears into ordinary life. Decide the payment before the spending begins. If your income changes, lower the extra payment temporarily, rather than missing required payments. A plan that survives a difficult month is better than a plan that only works in a perfect month. Step 5. Reduce the cost where you can and ask for help early. Call your card company before you miss a payment if you expect trouble. Explain what changed, what you can afford, and when you expect normal payments to resume. A company may offer a hardship arrangement, but nothing is guaranteed. Get the terms in writing and understand what happens to the rate, fees, and account status. A balance transfer can sometimes reduce interest for a limited period, but it may involve a transfer fee, a promotional end date, and a higher rate later. Do the math before moving a balance, and do not use the new card to create another balance. Be cautious with debt relief companies. Be especially careful with anyone who guarantees that debt will disappear, charges fees before settling, or tells you to stop communicating with your creditors or stop making payments. After the payoff plan starts, build a small cash buffer.
It does not have to be a huge emergency fund on day one. It needs to be large enough to help with a tire, a prescription, a repair, or a short income gap without immediately reaching for the card. Keep the buffer separate and accessible. When you use it, refill it. This is what stops one unexpected expense from restarting the debt cycle. Then track progress in milestones. The first balance reduced, the first card paid off, the first month with no new charges, and the first emergency paid with cash. Here is the 30-day reset. Today, remove the payoff card from shopping apps and collect your latest statements. This week, create the one-page debt map and choose Avalanche or Snowball. On your next payday, automate minimums and send the extra payment to one target. Before the month ends, call any issuer you may struggle to pay and ask about available options. Start a small buffer, even if the first transfer is modest. Credit card debt is a math problem, but it is also a behavior and cash flow problem. You do not need a perfect plan. You need a visible target, a repeatable payday routine, and enough protection that one surprise does not undo your progress. Subscribe for simple, practical U.S. personal finance videos. Comment reset if you are starting your debt map. And remember, this video is general education, not individualized financial, tax, or legal advice.